Welcome to this New Year's Eve edition of the Tech Today podcast. It's your host, John Mayetta. Earlier today, we published an article about unrealized bank losses and the Bank Term Funding Program and what that may mean for interest rates insofar as the Federal Reserve is concerned. We've talked about this topic for several times anyway in the past month. We've written about it several times over the past 4 or 5 weeks. And I gave the example of Bank of America in the note. And if you look at B of A, let's take a step back. If you look at the banking industry, as of the end of Q3, the United States banking industry, the FDIC banks had $684 billion in unrealized losses. If you look at B of A, they had $136 billion of unrealized losses, $132 billion of held to maturity security of unrealized losses, and then the last few billion were on the available for sale side. If you look at the 132 billion in unrealized losses, of those 107 billion were mortgage-backed securities, and those agency securities, those mortgage securities, carried a yield of 2.12%. This was as of the end of Q3 when Bank of America reported. So a 2.12% yield suggests that B of A went into the market and bought these securities when Fed funds was at zero. And when the Fed was out there exercising QE to the tune of 120 billion per month. That's when mortgage rates obviously were very low, we're at 2%. And so B of A went out there, gorged on cheap debt, as so many other banks did. And now those securities are underwater. So how do you get those securities above water? Well, over the past 3 quarters of the year, the Fed has supported the banks with its Bank Term Funding Program, the BTFP, that facility, which allows banks to borrow from the Fed. When they do so, the Fed marks up the value of the collateral to par value. That collateral is what's underwater today. And so the Fed's marking that up so the bank doesn't have to take the hit. And they can, then borrow and have the liquidity that they need to meet depositor demand and whatever other liabilities they may have. As of the past couple of weeks, the outstanding balance of the Bank Term Funding Program has accelerated because the Fed has created an arbitrage opportunity. The Fed has reduced the rate it charges banks for borrowing through the BTFP. It was in the low 5s. And now, well, as of 12/28, it was at 4.83. So what many banks are doing is they're borrowing from the Bank Term Funding Program at 4.83%. And then they're getting a return, short-term return, whether it's overnight or some other short-term facility from the Fed or elsewhere at north of 5%. And they're earning a return on this Bank Term Funding Program. It's now an ARB opportunity creator. That wasn't the original intention for the facility. So back to getting these available for sale securities and held to maturity securities. How do we get their valuation such that they're no longer underwater, such that we don't have these massive unrealized losses on bank balance sheets? Well, if it were up to me, I would allow these banks to take the hit, suffer the losses, allow those unrealized losses to become realized. Now, I understand that the Fed's never going to allow B of A or any of the big 4 banks to feel, but allow some of these other banks to feel the pain, allow them to merge with peers or with larger banks and survive that way, as opposed to continuing to bail these guys out. So the way I see it, the Fed has a couple of choices. It could continue to run this BTFP in perpetuity and allow banks to borrow from the Fed while marking up their collateral to par. Or the Fed can allow the BTFP to expire when it's scheduled to expire on March 11th. Or perhaps the Fed can, rather than renew the BTFP for another year, renew it for 6 months or month to month. And then what you would do if you're the Fed, you re-inflate the bond market by lowering interest rates And then when you've eliminated a significant amount of these unrealized losses on bank balance sheets, then you end the BTFP. I believe if the bank ended the BTFP now, as many analysts, or at least a handful of analysts that I've seen believe the Fed's going to do, I believe you're effectively pulling the rug out from under the banks, and that the banks would dramatically reduce credit. They would tighten credit if you remove that crutch from the marketplace. If the banks whom have these large unrealized losses on their balance sheets, if they no longer have the crutch in the form of the bank term funding program, they're going to dramatically reduce credit. And you will have your hard landing, much as you would have had it in March of 2023. So if the Fed wants to do this in an orderly fashion, it will start to reinflate the bond market and get those securities, such as the ones the agency, the mortgage backs on B of A's balance sheet that are at a 2.12% yield. Remember, there's 107 billion of mortgage backs on B of A's balance sheet that are in a loss position of 107 billion that are at a yield of 2.12%. And so you've got to get interest rates close to the zero bound, get the Fed funds rate close to the zero bound again, if you're going to get bonds such as those that are at a 2% yield back above water. So I know the Fed has kind of communicated it doesn't have the intention of going back to zero, but I don't see how it doesn't. And I'm afraid that, within a year, we'll be close to zero and we'll be doing the QE thing again. I think if we hit a hard landing for any reason at any point this year, and let's say at that point in time, Fed funds is at 4.75, 4, wherever it is, I believe the Fed's going to zero pretty much overnight. If there is a hard landing, there'll be zero. Fed funds will be back at zero with QE. But if we don't have that hard landing, I would expect the Fed to nonetheless reinflate the bond market, even at the expense of reigniting inflation and bailing the banks out. So in other words, the Fed will bail the banks out, will bail out commercial real estate owners who are underwater in these buildings before they'll worry about inflation. And so the Fed has got itself between a rock and a hard place. I don't see how Powell comes out with his legacy intact. He hasn't earned my respect. And I don't think he'll take any sort of action that's going to earn my respect for the duration of his time as Fed chair. That's all for now. Happy New Year. See you next time.